The NFP report this Friday isn't just the first NFP in 2026. It's the key data that could answer the question every trader is asking now. Will the Federal Reserve continue cutting rates in the months ahead? Here's why this matters. Inflation is now close to the Fed's target. November NFP wasn't as weak as markets expected, and the only concern about the labor market is the rising unemployment rate. If the job market shows signs of a slowdown, the Fed may have reason to extend the rate cut cycle. And that's what makes this week's NFP so important. The report will be released on 9 January at 4:30 p.m. Stay with us as I break down what the data could mean for markets and how to trade around it. Before I break down the upcoming jobs report, make sure you subscribe to our channel and turn on notifications so you don't miss out on any market updates and insights. Looking back at last month's NFP release, the October and November job figures were reported together. October showed a negative number, with non-farm payrolls declining by 105,000 jobs. November, however, saw a rebound. Job growth came in at 64,000, exceeding market expectations. Despite the recovery, the unemployment rate continued to rise to 4.6%, showing that signs of job market softness remain. The wage growth, on the other hand, also failed to meet the market forecasts, with average hourly earnings increasing by 0.1% month-over-month and 3.5% year-over-year. The uptick in unemployment dampened the market sentiment. The US dollar weakened, while gold, oil, and all three major US stock indices edged lower following the NFP report. To trade around the NFP release, you've got to watch the forecast numbers. Comparing these forecasts to the actual data gives you a clear picture of where Forex, commodities, and stocks could move. December NFP is expected to show 57,000 new jobs, slightly below November's job growth, while the unemployment rate is projected to edge lower to 4.5%. Wage growth, however, is expected to strengthen, with average hourly earnings rising 0.3% month-over-month and about 3.6% year-over-year. So how could the market react to the NFP report? And what should traders watch out for as volatility kicks in? In a moment, I'll break down three key assets: the dollar index, gold, and S&P 500. So stick around for the full technical analysis. Start with the US dollar index. The DXY has recently rebounded from its recent lows. If the NFP report meets or exceeds market expectations, the dollar could strengthen and move back toward the 99 level, with resistance at 99.38 and 99.70. Conversely, a softer report would likely weaken the dollar, pulling the index toward support at 98.37 and 98.06. Now let's look at gold. Gold has been trending higher amid recent geopolitical developments and ongoing rate cut expectations. A weaker than expected NFP print could extend the rally, pushing prices toward the resistance zone between $4,569 and $4,625. On the flip side, a stronger reading could pressure gold, pulling it back toward $4,250 or even $4,192. And now, the S&P 500 index. The U.S. stock index is trading in range as the market waits for the jobs report. If the NFP report comes in stronger than expected, the index could edge higher towards 6,976 or 7,026. However, a weaker reading may drag the index lower, targeting 6,769 or 6,720. That's the full breakdown. Remember, this is just my perspective on the market and not financial advice. If you find this useful, let me know in the comments. Hit the like button, share it with someone who needs to see it. And don't forget to subscribe with notifications on so you don't miss the next market updates.